In this video, we're going to talk about 4 strategies to help crash-proof your portfolio. And I got to be honest, I do think this is actually one of the most important videos out of the 82 videos that I have released to date. I believe over the long term, this video might help investors the most. Purely my opinion. We often fear a market crash, and rightly so. The United States market is at record highs, and it's been 10 years since the last market crash. So, if the crash did occur, I want to get into these 4 strategies on how you can do well in a market crash. But before we begin, hit that subscribe button and notification icon for more videos on investing and the stock market, and also drop a like on the video if you feel it is important for investors to stay prepared. So, the first option to help crash-proof your portfolio is having a certain percentage of it in cash and cash equivalents. And first, when I talk about cash, I'm mainly talking about cash equivalents and money that is earning interest. Don't just put your cash under your bed or in a bank earning nothing. Make sure it is in an account that is earning interest. What Warren Buffett has most of his cash in is treasury bills, and this basically is a cash equivalent that is earning interest. It's not sitting there getting eaten up by inflation. So, an investment in cash and cash equivalents may sound boring or even silly, but let me tell you why it's so important to hold some cash in your portfolio. First of all, your cash can't crash. The stocks you own can crash, your bonds can crash, your real estate can crash, but the cash you have cannot go down. It's always going to be there, so depending on how much cash you have, it is going to have an effect on stabilizing your portfolio. The second reason why it's important to have cash is because when stocks do crash, you can purchase them when they are cheap. I so often hear this, yeah, just buy stocks on the dip, buy stocks when they are at a discount. It's an easy statement to make, but the only way you're going to buy stocks in the dip is if you have cash in your portfolio, available and ready to hit the trigger. If you do not have cash ready, then how else are you going to pay for the stocks after the dip? What, are you going to sell some of your stocks once they have gone down? Well, that means you're selling cheap and buying cheap, so you're not profiting in any way. You must have cash at the ready to deploy when stocks have slipped downhill. Now, about the likelihood of a recession in the United States. The factors point out that it is fairly likely to happen within the next couple of years. Ray Dalio says that there is a 70% chance of a market crash before the next elections in 2020. I've done a whole video on the chances of a market crash occurring. I'm not going to go over it again. There should be a link now that will show you the video. But either way, there is a good chance of a market crash, which means cash is vital. And remember, when I say cash, I'm talking about interest-bearing cash or treasury bills. Cash that is still going up in value but is incredibly safe. If you still don't think cash is an important thing to have in your portfolio, you don't have to take my word for it. Let's look at some of the best investors in the world and see how much cash they have in their portfolio. Berkshire Hathaway is the firm run by arguably 2 of the greatest investors in the world, Warren Buffett and Charlie Munger. As of the first quarter of 2018, Berkshire Hathaway had 35% of their portfolio in cash. As of September 2018, they have even more. Now, I'm not saying you need to have this higher percentage of your portfolio in cash, but you do need a certain amount of it in cash. I personally have around 15% of my portfolio in cash and cash equivalents. So, my first principle to crash-proof your portfolio is have a certain percentage of your portfolio in cash and cash equivalents. Okay, moving on to the next way to help crash-proof your portfolio, and that is investing in gold. Something that a lot of investors might not know too much about. Let me show you why gold is a great option for crash-proofing your portfolio. We'll first look at the history of the gold price and compare it to the last stock market crash. So our last stock market crash was in September 2008, which is right over here. The price was around $900 before the market crashed. Then obviously the market crashed and we saw a slight dip in gold prices, which was very slight. What happened after that little dip was the stock price went up by 2.5 times in just 2 years. It went from being $750 in the dip to $1,900 in September 2011. So what happens with gold is that in a market crash, people panic about owning stocks. They see the stock prices around them crashing and they end up running for the hills. And when I say running for the hills, I mean running to safety. And gold has been known as a safe physical investment. So in a market crash, people want security and they go to gold. If there are more people who want to buy gold, it's simple, supply and demand. It results in higher gold prices. So, gold is a great hedge to have in case of a stock market crash, and you could see your investment do very well in and after a market crash. So the question then becomes, how do we invest in gold and how much should we invest in gold? That's a good question, and I'm going to look to Ray Dalio to help answer this one. So currently Ray Dalio, in his investment fund Bridgewater, has about 6% of his portfolio in gold, and he invests in gold through two different funds. First is the SDPR Gold Trust, ticker symbol GLD, and this fund seeks to represent the performance of the price of gold bullion. Ray Dalio has 4.6% of his portfolio in this option. Secondly, Ray Dalio has 1.4% of his portfolio in the iShares Gold Trust, ticker symbol IAU. This trust's objective is to reflect the performance of the price of gold. So, if you want to invest in gold, I'd recommend looking closely at these two options. I personally am looking to take a position of about 5% in gold. Now, I just want to make a quick disclaimer. Currently, gold prices have gone down quite a bit, and I personally have no idea what gold prices will do in the short term. They could keep going down, but in the long term, I'm more than happy with this investment. As Jim Rogers says, I want to own gold when everybody hates it, and at the moment, gold prices have gone down a lot, and people do not seem to be liking it. That's why I'm going to buy. The third way to help crash-proof your portfolio is to diversify across countries. As I've alluded to before, the US stock market has a fairly decent chance of crashing, according to the likes of Ray Dalio, the Buffett measure, yield curves, etc. Not saying it will crash, but there is a chance. One way to help mitigate this risk is to have investments in different countries, not just the USA. I've talked about China a fair amount on this channel. Charlie Munger has said that the best companies in China are cheaper than the best companies in the United States. It's a growing economy, actually growing a lot quicker than the USA. Its stock prices are cheaper, and there are some decent companies to buy over in that part of the world. Not saying there aren't risks with Chinese stocks, but I think there is a greater risk in having all of your money in just one country. Another option is India. Again, this is a growing economy with cheaper prices than the United States. Warren Buffett has actually just made an investment in a big Indian company, which is very interesting. Also, Monish Pabrai has most of his portfolio in Indian stocks. So there are two gurus that have investments in India. Those are just some options that come to the top of my head when thinking about different countries to invest in. There are obviously a lot more, but it definitely helps mitigate risks and crash-proof your portfolio more if you have money invested in a bunch of different countries. And the final way to help crash-proof your portfolio is to buy stocks that serve people's needs. In a recession, people cut down on certain things. What they don't cut down on is buying things that serve their basic needs. For example, food. They're not going to buy less bread in a recession. We all need to eat. So here are some examples of some sectors you may want to look deeper at. First is the utility sector. This includes stocks like gas and power. Now technically you don't need electricity to survive, but we all know we use electricity like we need it. And I don't see us cutting down too much on electricity in a recession. The utility sector is not 100% recession proof, but it will do better than most sectors in a recession because it serves people's needs. Next, we can talk about consumer staples. Consumer staples are goods that people are unable or unwilling to cut out of their budgets regardless of their financial situation. So any stocks that sells consumer staples as their main income is not a bad safety bet. Discount retailers are good examples of stocks that do better than others in a recession. Instead of spending money at a more expensive store, consumers cut down on their spending in a recession and thus prefer to shop at cheaper retailers. Discount retailers. Some examples of discount retailers that you might want to look at owning are Walmart and Target, who generally sell cheaper items. And those are 4 vital strategies that I think everyone should at least be looking at to implement in their portfolio. I personally am currently doing strategy 1 and 3, and I'm looking to buy gold as well in the near term future. I'll do some videos on that, so all my subscribers will be able to see what I'm doing over there. And I do think this is one of the most important videos that I have released to date, so if you guys do want to, please drop a like to spread the message of investing smarter. Yeah, I would really appreciate that. I hope this video helps you guys out, and make sure you stay tuned for more videos by subscribing to the channel. Let me know in the comments if you have implemented any of these strategies or have any other strategies that you'd recommend to help crash proof your portfolio. I'll see you in the next video everyone, and make sure to invest smarter.